What happens when the person preparing taxes is also the person getting audited? And the story keeps changing. Here's the money roller coaster the court lays out. On his own individual return, the petitioner reported zero taxable income for years 2015 and 16 and claimed refund of about $5,000 and roughly $6,000. And then for 2017, he reported a small amount of taxable income and still claimed around $5,000 back. In total, he was asking in vicinity of $16,000 in refunds across the 3 years. Then the IRS showed up with the notice of deficiencies saying, no, actually you owe deficiencies of about $7,000, $24,000, and approximately $11,000 for years 2015, 16, and 17. That's close to $42,000 in total deficiencies. And then it got sharper. The IRS also assorted Section 6,663 fraud penalties of about $5,000, $18,000, and $8,000, totaling about $31,000 in penalties. Do the math swing using only what's in the opinion from about $16,000 expected back to about $73,000 demanded in deficiencies and penalties. That gives us about $89,000 in the opposite direction. And the court's ending? We sustain respondent's determination in full. That's the theme. When the paperwork vanishes, so do the deductions. And the court starts using the word fraud. I'm Alex Dvorkin, CPA, a certified public accountant in the state of California. If you like learning how U.S. tax actually works, in real life, messy facts, awkward testimonies, and all that, please like this video and subscribe. On this channel, we review and analyze U.S. tax court cases so we can understand how U.S. tax law actually works. In this video, we cover the tax court decision in the case of Jack Goodwill-Oikerhe versus Commissioner of Internal Revenue, decided on February 11, 2026. The court starts by telling us who we're dealing with. The petitioner is described as a highly educated individual who wholly owns an S-corporation, Golden Express International, JAI, through which he engages in tax return preparation and other services. He lived in Baltimore, Maryland, at a residence on Tanner Avenue. It was a 3-story home, and during the years at issue, he used the basement exclusively for JAI office, while the top 2 stories were living quarters. But here is the owner's twist. The home was owned by his brother, who lived in Nigeria, and the petitioner had only verbal agreement to use it. Family also shows up in a second way. The petitioner claimed deficiency exemptions for 2 nephews, born in 1997 and 1998, who attended school in Ukraine during the years in issue. The court notes the brother paid at least some of their school fees. And yes, education matters in this opinion. The court lists a bachelor degree, a master's degree in accounting and finance, and that he was a PhD candidate starting in 2016. It also emphasizes he took accounting and taxation courses, including coverage of cash basis versus accrual basis accounting. That becomes important later because JAI was stipulated to be cash basis operation with a lot of money moving outside the banking system. JAI took payments primarily in cash and paid expenses primarily in cash, did not deposit all receipts, and paid few expenses from its bank account. It used spreadsheets maintained by cousin, but the petitioner didn't review underlying records when preparing returns. He relied on numbers handed to him. Meanwhile, outside JAI, the petitioner also worked for a car dealership, Bob Davison Ford, called BDF further, as a lot attendant. The court describes the job as moving customer cars, sometimes shuttling customers, and general maintenance like cleaning floors. And here's the key fact. BDF discouraged employees from using personal vehicles for work. The company provided shuttle vehicles or dealer-tagged cars. The court bluntly states, there was never a time when BDF employee would need to use personal vehicles for work-related tasks. Nor did BDF employee need personal cell phones to do work-related tasks. That line is basically the court putting a giant nope stamp on later mileage claims. What the return reported: deduction expenses and the fine line approach. JI filed forms 1120S for 2015, 2016, and 2017. It reported gross receipts of about $116,000, about $125,000, and approximately $83,000 for those years. JI also reported a bunch of expense categories. For example, it claimed rent of about $9,000 each year. It claimed freight and purchases of roughly $80,000, $82,000, and $49,000. It claimed bad debt in the low thousands each year. In 2016 and 17, it claimed travel and entertainment of about $7,000 each year. In 2015, it claimed on employee compensation of about $14,000, and in 2017, commissions of about $8,000. On the petitioner's individual return, the picture was basically no taxable income for 2 years, refund claimed, and then a small amount of taxable income in 2017 with another refund claimed. He also claimed dependency exemptions for the nephews each year, a property tax deduction in 2016, and unreimbursed employee expenses deductions for vehicle and cell phone costs in 2015 and 2016. Those unreimbursed employee expenses were not small. For 2015, he claimed total unreimbursed employee expenses of about $10,000, including vehicle expenses of about $8,000 and cell phone expenses of $1,000. He reported 14,000 business miles and vehicle use of 98% for business, and claimed he had no other vehicle for personal use. For 2016, he claimed unreimbursed employee expenses of about $8,000, including vehicle expenses of about $5,000 and cell phone expenses of about $3,000, reporting another 9,000 miles for business use, again claiming 98% business use for the vehicle. And the court points out something almost comedic in its seriousness. Those employee expenses were implausible compared to wages. The opinion notes his total W-2 wages were only about $4,000 in 2015 and about $9,000 in 2016, while he claimed unreimbursed employee expenses of about $10,000 and $8,000. The court says this is simply implausible. The audit consisted of 4 meetings, few documents, and a great flood story. IRS revenue agent examined the returns. He met with the petitioner 4 times, 2 meetings in February 2018, 1 in June 2018, and 1 in July 2018 at Antana Avenue residence. The agent asked for supporting documents. The petitioner provided only a few. The agent explained his procedures. Originals were reviewed and handed back the same day. Copies might be taken, logged, and mailed back. The only documents the agent took were copies of some tax prep client invoices, which he later mailed back. The petitioner said he had more documents but didn't provide them. He didn't provide bank records, so the agent had to summon them. When asked to reconstruct records from bank statements, he couldn't. The petitioner showed a drawer or 2 of documents, but said he wasn't prepared to go through them. He said he'd bring the cousin who maintained spreadsheets, but never did, and never provided the spreadsheets. Then came the explanation for the missing records. A flood in early 2017 allegedly destroyed them. He showed unsigned plumbing proposals, admitted the work wasn't completed, took no photos, filed no insurance claim, and the agent saw no evidence of flood damage even after walking through the basement. The court later says it viewed the flood claim as nothing more than self-serving, unsupported testimony. The petitioner also claimed the agent took his records and didn't return them. The court rejected that too, finding the agent returned originals the same day and mailed back the only copies he took. It calls the claim baseless. So if you're keeping score, there was no documents, no backups, no reconstruction, and the flood is basically the tax version of my dog ate my homework, except the dog didn't sign the plumbing proposal either. The specific deductions where the court says no over and over included nephews and dependency exemptions. The IRS considered the nephews met several technical requirements, including relationship and age-related rules, but argued the petitioner failed to prove the nephews lived with him more than half a year, or that the petitioner provided more than half of their support. During the exam, the petitioner said they visited but couldn't say when or how long. At trial, he testified they stayed with him during winter breaks, approximately December to February, and summer breaks, approximately May to August, but he offered no documentary evidence and no testimony from the nephews. As for support, he showed only 2 or 3 money transfer receipts totaling approximately $1,100 and couldn't name the school he said the money was for. He claimed he paid flights but produced no documents. He didn't know how much he paid overall and admitted his brother provided at least some support. The court found his explanations inconsistent and unsupported and held he wasn't entitled to the dependency exemptions. Now let's look at 2016 property tax deduction. He claimed a property tax deduction of about $5,000 in 2016. He told the agent it related to taxes on the Montana Avenue residence, showing a water bill, a property tax bill, and a City of Baltimore receipt dated 2017 for about $3,000. He argued the payments date didn't matter. The court disagreed. As a cash basis taxpayer, deductions are taken when paid, and the record didn't establish he paid any relevant tax during 2016. It also emphasized he didn't own the home, and he failed to prove he was an equitable owner, so the deduction was disallowed. Now let's look at the unreimbursed employee vehicle and phone expenses. This is where BDF policy becomes the villain. The petitioner told the agent he used his personal vehicle to pick up parts and shuttle customers, but provided no documentation and couldn't explain calculations. The agent called his supervisor, who said BDF would never allow personal vehicle use for company business. The petitioner then claimed the manager didn't know about the higher level agreement, but refused to go to BDF with the agent to clear things up. Another manager had no knowledge of any request to use the personal vehicle either. At trial, this story shifted again. The petitioner said the expenses were all for BDF, then also for another agency, then mostly for shuttling customers, then not for picking up parts, then indirectly connected to GI. The court wasn't persuaded. It also noted vehicle expenses require strict substantiation, and he didn't meet them. Result, no deduction. GI follow-through business deduction also met a lot of scrutiny from the court. The opinion walks through multiple GI deduction and repeatedly comes back to the same point. No records, no credible details, and the court won't just guess. Bad debts were disallowed, especially because GI was cash basis, and the court emphasized unpaid fees generally aren't deductible bad debts unless previously included in income. The petitioner's testimony that he sometimes recorded income before receiving it contradicted the stipulation and the returns. Rent was disallowed except for one allowed piece tied to the 2017 City of Baltimore receipt. The agent allowed $1,156 for 2017, calculated as 1/3 of the receipt because the basement was treated as 1/3 of the residence. The court left it there. Freights and purchases. The agent allowed documented amounts, a Jaguar purchase of $78,000 in 2015, and shipment documents totaling $2,930 in 2017, and disallowed the rest. The court agreed. Travel and entertainment. GI claimed $6,734 and $7,426 for 2016 and 17, but provided no details or documents. So strict substantiation wasn't met, and therefore the deductions were disallowed. Non-employee compensation and commissions, again, no records, vague shifting explanations about who was paid, how often, and how much. The court refused to estimate, saying it needed a basis and wouldn't engage in just guessing. The fraud penalty, when the court stops calling it sloppy, was applicable in this case. The fraud penalty under section 6,663 is 75% of the fraud-related underpayment. The court explains the IRS must show supervisory approval and prove fraud by clear and convincing evidence. On approval, the IRS issued a 30-day letter on April 26, 2019. The group manager signed it and also signed a civil penalty approval form. The form had some internal confusion. An attachment checked yes for a different fraud-related penalty and no for 6,663. But the parties stipulated the form approved the section 6,663 penalties for all 3 years. The court accepted that and found approval timely. On intent, the court runs through badges of fraud, like inadequate records, implausible explanations, failure to cooperate, dealing in cash, and lack of credibility. And then it lands the point. The petitioner was a well-educated businessman and an experienced tax return preparer, yet he significantly overestimated the deductions on both his and JI's returns, provided minimal documentation, made inconsistent statements, and gave flawed and basically lack of records as his claims for explanation. The court found this incredible. It concludes the IRS proved fraud and holds him liable for the section 6,663 penalties. Final thought on this is that if you're going to run a cash-heavy business, claim big deductions, and then explain missing support with a flood nobody can see, while also claiming the IRS agent stole your paperwork, just understand you're basically auditioning for the role of an example in tax court memo. The court wasn't impressed by vibes, family bonds, or I didn't count pennies and dimes energy. When the legal test required proof of where the nephews lived and who paid support, it had to be met. It wasn't impressed by mileage claims when the employee's policy said employee didn't need personal vehicles or phones for the job. And it definitely wasn't impressed by business deduction billed on total supplied by someone else with no receipts, no invoices, no reconstruction, and no credible story. The lesson is simple here. If you want deductions, build the records like you expect to defend it, because one day you may have to. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. If you like this video and found this information useful, please like this video and subscribe to our channel. And I'll see you in the next tax court case review.